Hello students. For more videos, press your like button and subscribe to my channel. In the previous video, we have seen about the definitions of financial structure and capital structure and optimum capital structure. And in this video, I am going to explain about the features of an appropriate capital structure. Appropriate is nothing but the meaning of optimum. So in the previous video, I have explained about the optimum capital structure. So what is meant by optimum capital structure means the right mix of equity and debt. How much equity and how much debt should be there in your capital structure. So that what will happen means the wealth of a firm, the value of your firm will be at maximum. So at this optimum capital structure, your cost of capital also will be at minimum and your company's market price per share will be at maximum. So only the financial manager have to fix the optimum capital structure. Now let's see the features of an appropriate capital structure. The first one is minimum cost. An appropriate capital structure should attempt to establish the mix of securities in such a way to raise the requisite funds at the lowest possible cost. So what I am telling means always the capital structure, this optimum capital structure should always ensure the minimum cost of your capital. And that would, what will happen means it will increase its ability to generate more wealth for the company. Yes, of course, all times the all cost of yours, so different sources of capital, it won't be same in all situations. So what you have to do, you have to first find out the weighted cost of capital. It should be ascertained, it should be fixed on the basis of weighted average cost of capital. And also the financial manager have to keep all the expenses from the starting of issuing till redeemable. Always the expenses have to be at minimum so that the company can expect a maximum return for their equity shareholders. Okay, so the first characteristics is minimum cost. And then maximum return. Of course, even an individual, even a sole proprietor, even a normal man always will think about the return. Always the return should be at maximum, the cost should be minimum. This is the favorite dialogue for all the individuals, and not only for the individuals. Now it's a company, for company also. The managers, the top directors, top persons always will have the quote that minimizing the cost and maximizing the return. So when you want to increase your profit, when you want to maximize your profit, always the firm, always the company should follow your concept called trading on equity. Trading on equity is nothing but the concept like the company should have a debt proportion in their capital structure almost high debt when compared to the equity. If you have a debt higher, because the cost of debt is cheaper than the cost of equity. Okay, so why cost of equity is very high means there will be a more expectation from the side of shareholders. So instead of filling their expectations, we can go for a debt. So cost of debt is very, very cheaper than the cost of equity. So the company, when the company wants to increase their profit, they have to go on the boat called trading on equity. This was the second features. And the third feature is minimum risk. Of course, there is a risk. Even an individual or it's a big company, always there will be a risk. You have to expect the risk. Without risk, we can't earn a profit. So when you're fixing this appropriate capital structure, when you're fixing this optimum capital structure, your risk can be at minimum level. But we can't say that there is no risk at all, no risk at all, 0% risk. It won't be. So the risk should be at minimum when you are determining your best optimum capital structure. So when your company having a debt content is high, of course there is a financial risk. So financial risk is nothing but we have to pay the interest. So financial risk is there. So we can reduce our risk. Okay. And the fourth one is maximum control. Always the control should be lie on the shareholders of the company. For example, in your family itself, the control should be always lies on the shoulder of your mom and dad. In the same way, the company's control always will be lie on the shoulder of shareholders. We should not give it to the other outsiders, other or external parties, because controlling is one of the quality or one of the characteristics of a company. So you should have maximum control with the existing equity shareholders. Okay, so always the ultimate control of the firm rests with the equity shareholders, because they only having the right to elect the directors. Okay, not others. So others will have some voting right, but most of the rights will lies on the shoulder of the equity shareholders. So this optimum capital structure of a company, it should not dilute the control of equity shareholder of the company. So that is why what the company will do means, they will issue the convertible debentures. It will be issued with great caution, with more attention. They will issue the convertible debentures to the parties. Why there is a convertible debentures means to have a control. Later the debenture can be converted into a shares, so that always the control will be lie in the company itself. So debentures will be turned, debenture holders will be turned into a shareholders, so that the control will be at maximum. So instead of giving the equity shares to the public, the company what they have to do means they have to issue the shares to the existing shareholders, and remaining like debentures, bonds, these are the things can be given to the outsiders, so that the control will be inside, not outside of the firm. So this optimum capital structure, based on that you have to fix your optimum capital structure. And the next thing is flexibility. So this optimum capital structure will have the quality of flexibility in it, according to the situations, according to the change in conditions in the market of your company. This optimum capital structure can do some necessary changes. For example, 40% debt have to be can be increased to 60%, or 20% equity can be increased to 50% equity. So according to the changing environment, you can change your capital structure. That flexibility it has. And the sixth one is proper liquidity. So the company's optimum capital structure always have to ensure that there is a proper liquidity in your company or not. If there is no liquidity, if there is no future cash inflows, you can't repay the debt. Not only the debt, you have to pay the interest every month or every year. So for paying your interest on debt, you need some cash, you need some cash flows. So the liquidity should be at proper. So this optimum capital structure always will ensure the proper liquidity. And the next is conservatism. Conservatism, na, it's like a behavior. The how the company, it's like a conservatism behavior. Okay, so always conservatism means they have to look back. They have to look back into the policy, what they have followed before for the situation, what the suggestion, what the ideas they have been taken, what the solution they have been taken before. So they have to look back. They have to follow some old principles to have a successful profit, successful life of a company. So the firm has to follow the policy of conservatism in devising your capital structure. Okay, so this would help in maintaining the debt capacity of the firm even in unfavorable circumstances. So what is your company policy says about your debt capacity? If the company policy says that this company have a capacity of only 60%, means you have to get a debt from others up to 60% only, not beyond that. If you are beyond going for debt 60%, then you will suffer at a loss. Then you have a more risk. You can't pay the debt, you can't pay the interest, so that you will be suffer. Your value of the firm will comes down, so there will be a collapsed. Okay, so you have to follow some conservatism. And the 7th one is full utilization. When you're fixing this optimum capital structure, this ensures your utilization of resources of finance. You are getting a loan. You are getting a loan from the financial institutions, and you are going for more debt at 7% or 12%. So if you are going more and more debt, you have to use that. If you are not using, if you are not managing, if you can't manage your resources, then it will be fully waste. So without managing, without handling your sources of finance, all the sources, it will be waste. So simply you will be paying the debt. You are getting the debt and you are simply keeping the resources, and you are not at all utilizing the debt for efficiency purpose, for the developing purpose of a company. If you are not used at all, you have to pay simply the debt, simply the interest. So that is so only the company's financial manager have to fix the optimum capital structure. That is how much I need to get the debt from outside. That proportion have to be fixed by doing a lot of research, by doing a lot of survey. They have to fix the right mix of equity and debt. Okay, so both underutilization and over utilization of capital will leads to danger. If there is no capital at all, what we will do, there is no production at all. So there is no production, that we can't meet our financial needs. So a lot of things will be happen if there is no capital. If there is over capitalization, the resources will be at wastage. Okay, so you have to have a proper capitalization, that is the proper capital structure. You have to avoid both undercapitalization and overcapitalization. And the 9th one is balanced leverage. You have to balance your debt and equity. Both the ownership securities is nothing but the equities, and the creditorship securities means nothing but the debt. So you have to balance both the types at a correct proportion. Okay, so that your interest on debt will be low and your rate of capitalization is very high. Okay, always your market price should be high, and the cost of expenses, overall cost of capital, it should be at minimum. So you have to balance your equity and debt. That was one of the feature of a optimum capital structure. And the last one is simplicity. So this optimum capital structure, it was very easy to understand and easy to operate. For this purpose, the number and type of securities issued should be limited. So when you have a deep knowledge, if the person have a well knowledge and expertise in the fixing of capital structure, it is very simple and it will be very easy to operate. So simplicity is one of the features of a capital structure. I hope you all understood this video on features of a capital structure. Thank you all.